Hello and welcome to this week's edition of Econoday Unplugged. It's Tuesday, the 13th of October 2020. Mark Pender's across the pond stateside, and I'm Jeremy Hawkins here in London. So the world finds itself at a dangerous turning point as far as recovery from the coronavirus is concerned, with rising cases in many countries now forcing the reintroduction of various forms of containment measures that can only damage the prospects for global growth over coming months, if not quarters. However, while this may be good news for bonds, if it equates with still weaker inflation, it hardly seems to be troubling equity markets, which apparently regard bad news on the virus as boosting the likelihood of yet more quantitative easing from the central banks and possibly some additional fiscal stimulus too. That said, the IMF, the International Monetary Fund, has just revised up its global growth forecast for this year from minus 5.2 in June to minus 4.4%. That mainly reflects a smaller than originally expected contraction in second quarter GDP, but it's still an awful number and it won't incorporate some of the new restrictions recently announced. Growth in 2021 is put at 5.2%. That's down from 5.4% last time and means that GDP will be just 0.6% above its level in 2019. And although that's at least a positive number, it only comes courtesy of the emerging market and developing economies, as the advanced economies will still be well short. Inflation in advanced economies is seen at 0.8% in 2020 before climbing to 1.6% next year. But I suspect many central banks will be more than happy with that. So talking of happy, what is it to cheer us up from your side of the pond, Mark? Give us some happy numbers.
Happy numbers. If you're a used car dealer, you are a happy person. We just had the CPI today, and for the third month in a row, the prices of used cars and trucks are shooting through the roof. And that is in contrast, however, to the rest of or most other prices, which are definitely flat, and including shelter, which is and medical care too. But those two together make up more than half of the whole CPI basket, and they were medical care was unchanged in September, and shelter was up only 0.1%, and that compares with used vehicles up 6.7% in the month, 5.4 and 2.3 in the two prior months. New vehicles haven't been showing anywhere near the traction, but did rise a bit. And I guess this must be some COVID effect of and pushing perhaps lower wage workers. This is a guess to used vehicles. Have you seen anything like that on your side of the pond?
Not so much. Well, I think it's got to be said that on the whole, the car market, the auto market over here is still struggling to regain any traction. We have seen certainly increase in new car registrations, but I think you're probably right. The second-hand car market, as we call it, is certainly doing rather better, which may well be, as you say, just a symptom of the fact that people are genuinely concerned about what job prospects are, what wages growth is going to be over the course of next year or so. So it is helping to provide some kind of protection for demand of lower price goods.
And that's going to be if you're in the vehicle maintenance business, that has to be a good indication. But otherwise, the CPI report unfortunately didn't offer very much good news at all. The core, which is the most important reading, which excludes energy and food, was unchanged year on year at 1.7%. That was at the low end of Econoday's consensus, and won't be giving Federal Reserve officials much, reason to have much new confidence that price traction is building. And it's interesting. This whole year has been an interesting. As far as monetary policy goes, or fiscal policy, massive stimulus hasn't correlated at all yet with inflationary pressures, which is the traditional. And it's like you had been saying before about how important inflation is to European policymakers and to the expectations of European monetary policy. Whereas in the U.S., it's also inflation. That's true, but the Fed is more looking, I think, at employment, even though traditionally inflation is the ultimate gauge to what to expect. But if you can put in out unlimited stimulus and still see just prices just laying there, it's time to maybe, as it has through the whole last the last dozen years, to reconsider or to restudy or to to have a new look at how inflation actually behaves. It's a gigantic mystery at the very heart of economics, and so it has me speechless.
Well, I must say, in many ways, you're to some extent was paraphrasing what Christine Lagarde, the ECB president, was saying a week or so ago. I think, as we talked about in the past, there's this fundamental wholesale review of ECB monetary policy taking place at the moment, and hopefully they'll have some results out from that during the first half of next year. But certainly from the way Lagarde's talking, she's very much coming down on the side, well, look, we may have a target, we may possibly keep the target as is, but we really need to find out why inflation is as weak as it is, why it's been undershooting target for so long, and do we have to do something which perhaps bring the inflation target program itself, or the operation of the inflation target, more into what we might well now call the real world. As you say, I think from the public sector deficit side, it really is interesting, because we've got, let's be honest, record public sector deficit pretty well across the world at the moment, and not just by a little bit, we're talking by a massive amount, and yet we haven't seen inflation going up. So does that mean then that perhaps the bond market's got it right, in the sense that you look around sovereign debt at the moment, you think those yields are ridiculously low, they can't stay down there given the supply that's going to hit the market? Well, perhaps if inflation now has moved into the stage whereby 2% is almost too high, it's always going to remain lower than that. And indeed, perhaps central banks, fiscal policy makers are going to struggle to get inflation back into positive territory again. These low yields are going to be with us for an awful long time, even when the recovery starts to come about.
It's almost like Noah's Ark. The world is swimming in debt. And and so I don't know what the resolution is going to be. I guess there's no choice what we have to do now. But who's going to buy this debt eventually? It's all going to have to be monetized, maybe perhaps at the end, or all forgiven, or
That's the big question, isn't it? Whether or not anyone would actually be prepared to come out and say, okay, we accept we've been through a unique period, and therefore we're going to use a unique way of addressing it, and it may be partial or complete monetization at some point in the future. But it is interesting, given all the kind of disruptions we've had to the international economy, and you look at how well the financial markets by and large are continuing to function, largely courtesy of what these central banks are doing. I mean, just last week, we take within Europe, if you're looking for problems, you'll typically look at what's happening to spreads between, say, Italian BTPs or Greek bonds versus German bunds. Well, Greek bond yields are all-time lows at the moment. And this is at a time when you think there could well be, safe haveny panic buying of the likes of anything to do with Germany at the expense of the more peripheral Eurozone currencies. But it's simply not happening. And that's one reason why I think, although the ECB is certainly not happy with where inflation is, and we're talking just minus 0.3 at the moment on a year-on-year base for the headline inflation figure, it's still taken heart by virtue of the fact that the financial system across the Eurozone is still remarkably stable. And if nothing else, at least it can sort of hang its hat on that.
Can you touch on the UK labor? You were talking about good news. Tell us the good news in the UK labor market report, and also how the different measures. It's a mix of September and August and moving averages. It's hard to read, for a neophyte.
Yeah, it's hard for a Brit to understand as well, because there's so many we have coming out over here. I suppose, I mean, the good news is at the end of the day, unemployment is still relatively low. So if we take the International Labour Organization measure, the rate there, it did come in above expectations. It was 4.5%. The market was expecting 4.3%, which in normal times, that would be significantly higher. But given what's happening right across the world in terms of joblessness currently, perhaps that's not too much a surprise. But it is moving up. But, I think for the government, at least it's not moving up too quickly. We have an alternative measure called the Claimant Count. That saw just a 0.1 percentage point increase in the rate from 7.5% up to 7.6%. This is for the month of September. And that was well below market expectations. So I don't know. There's good light, I think, with all employment reports at the moment. There's good news and there's bad news. I mean, the bad news, I think, is looking as we go forward. I mean, redundancies over the last quarter saw a record increase. So I think, again, it's kind of still this case whereby labour markets, UK, Eurozone, are very much deriving support from these government help packages, which as they're phased out, and some of them are still going to be around for quite a long while yet, but necessarily it's going to start to see upward pressure coming through on a lot of these unemployment rates. And that I think is what's going to happen, particularly as far as the UK is concerned. And indeed, just moving on to the UK, I think their government's pretty well accepted that now, because we've talked about before about their furlough scheme, the so-called job retention scheme. That is still scheduled to end at the end of October, so this month. Last week, they announced it would be replaced by a new scheme called the Job Support Scheme, which basically amounts to the same kind of thing, but costs the government less. But in the last few days, they've already had to add something onto that in anticipation of what's already happening, this big second wave of the COVID at the moment. So, it does seem that fiscal policy across Europe continues to be loose, and I think there's more to come. Possibly, though, unless you work on the EU Commission. And this COVID rescue program, they've still got all sorts of problems with that. That is currently, this package, which is, you have the recovery fund, which is supposed to be the first really big pan-European rescue fund to operate right across Europe. Which will be funded by by joint European bonds. So potentially it's a massive thing for Eurozone markets. But it's currently sitting in the European Parliament, which is still trying to make the disbursement of these funds tied to rules of law. And that's despite the complaints coming out of particularly Hungary, but also Poland as well. And indeed, there was a report from one of the main Spanish newspapers this morning suggesting that because of the problems they've got trying to get agreement in the European Parliament, the actual programme itself may not come into effect until the end of 2021. So that'd be a year late. So there's still all sorts of problems, I think, concerning that. And it does seem that we've seen from some politicians effectively coming out and saying, now, look, you might as well just do your own thing to the individual countries and hope that fiscal policy will come via additional stimulus out of Angela Merkel sitting in Berlin, albeit Italy coming on a national basis. But it's going to be down to individual governments to really take responsibility for helping their economies rather than this coordinated effort which was supposed to be in place.
Well, Jeremy, what are the restrictions for individual countries and their debt to GDP? Are these being waived, or
they have been waived? And this is crucially, it's a good question actually. That's they crucially been waived in the past under what they call the Maastricht Treaty, which was the treaty which laid down the criteria needed for entry into the single market, or single currency, I should say. That laid down that budget deficits or government deficits to GDP ratios should be no more than 3%, and that's the cap on it, and also keep the deficit to GDP ratios of no more than 60%. Now, the 60% mark, I must say, has been exceeded by a lot of countries in the past, but it's been the deficit to GDP numbers that the EU Commission has been keen to make sure actually worked, and necessarily would put fines on individual countries to meet that. But they were waived as a result of the coronavirus. So it's kind of opened the door now for these individual governments to say, well, look, if the likes of the EU Commission can't get their act together and help us, we're going to do our own thing. And that's why we're going to see, time we get to the back end of this year, huge borrowing numbers coming out of pretty well all of Eurozone countries, which will bear no relationship to what these regional stability criteria stood for.
We're going to get the Treasury data.
Yeah.
Because
you've got some pretty big numbers your side.
Yes. Well, it's going to be, the Econoday consensus is for the September. Let me just see what that last number is here on my Econoday calendar. This is last I looked, it's going to be about 3.1 trillion. The deficit, the U.S. fiscal year ends in September. We're looking at the deficit for September. The consensus is now 115, which would just put it just a little bit over 3.1 trillion, which would be about 200% or so more than the 200% more than the prior year, which was already extreme going into this. We can't forget that the global economy was kind of grinding down amid global trade tensions and stuff, even before anyone even heard of the coronavirus. So, and U.S. debt was already extremely high, and now it's super extremely high. And now this number is released on a monthly basis in the Treasury. This report's probably going to be delayed because of accounting necessities for the final report. It's kind of an anytime untimed event sometime this week, probably later in the week, even though it's formally scheduled for this afternoon. So in Europe now, I see the UK has a monthly report. How does a country like Germany or Italy or France, how do they report their budget statements?
They do issue monthly figures, but it's got to be said that on the whole, I think most investors don't really pay that much attention to them. They tend to concentrate upon the figures which are released on a quarterly basis by the European Commission, and so those are certainly in line with yours. They've been trending upwards. I haven't seen the latest figures a little while now. I think they're probably running at round about where I think government debt, I think, as a proportion of GDP, that was up to just over 83%, if I remember rightly, as far as the Eurozone is concerned. But that was only for the, let me think, fourth quarter of 2019. So these numbers are, quite significantly out of date, and we won't really know what's going on as far as 2020 is concerned, really, until we get well into next year. But it's going to be safe to say that all these figures will be going through the roof. While we're on Europe, I suppose I should also mention Europe, UK, Brexit, because on paper, and we've been here umpteen times before, this could be a very important week as far as Brexit actually goes. Or at least I should say, Brexit's already happened, but the post-Brexit trade relationship between the UK and the European Union. Now, on Thursday and Friday, the 27 EU leaders will be holding their summit in Brussels. The main focal point of which, as far as financial markets are concerned, will be what they have to say about the state of the EU-UK trade negotiations. Now, the official round, I think it was the ninth round, was completed last week and achieved nothing. There are unofficial talks going on as we speak, and they presumably will run up until at least Thursday. But Thursday is seen as being this potential benchmark date because it's when Boris Johnson has said and is still maintaining that if there's no clear sign of an agreement at that stage, then he's going to walk away from any future discussions. So as things currently stand, if we don't get something coming out of this meeting to suggest that the UK and the EU are very close to agreeing something, then it could be potentially hugely destabilizing for UK financial markets. I think from the way the pound's been trading, the gilt market's been trading, indeed, even UK stocks have been trading for the best part of the last few months now, despite concerns that there's a growing risk that there won't be any kind of trade deal, which means in a nutshell that once we get to the beginning of 2021, the EU and the UK will simply resort to World Trade Organization rules, which means each country will be slapping tariffs on the other country. So it's worst case for both of us.
Jeremy, when would you see this destabilization affecting the markets? We haven't seen it really. Have we seen it much yet?
No, that's what I'm saying. We haven't. They've been trading remarkably stably so far, which I think to me suggests that investors and market participants are looking at what happened with the Brexit, the actual overall Brexit withdrawal deal itself last year. If you remember, we had a lot of talk about almost every podcast. I think we talked about it at some point, and there was this growing sense that there wasn't going to be any kind of Brexit deal, and the UK would just walk away from the European Union, full stop. There'll be no trade deal, nothing. But it went to the brinkmanship really right down to the wire. And then Boris Johnson finally came out this deal towards the back end of last year, when increasingly people are starting to think it's not going to happen, but they weren't prepared to go down the whole road which says it's definitely not going to happen. And I think because there was this last minute overall Brexit agreement last year, was this sense that there's a lot of politicking going on at the moment. There's a lot of brinkmanship going on. And the bottom line to the real problems at the moment, the two biggest obstacles concern the rules limiting state aid in the UK. Well, and basically the UK's view is, look, we want to be able to dish out whatever state aid we want to UK companies, whatever we may be. But of course, that will include Northern Ireland, which remains attached, although it's still part of the UK. It has effectively this open border with Southern Ireland. And that means that, how can the UK determine what's going to happen to Northern Ireland, where Northern Ireland is pseudo still part of the European Union? So that's one sticking point, and that comes under what the EU Commission is talking about. We need to have a level playing field. And the other big point is EU fishing boats access to British fishing waters. Now the British want to get most of that back. The French effectively want to maintain the access they have at the moment as part of the EU rules. And these two sticking blocks, well, really big walls have been built around them, and it's made it very difficult to get any kind of agreement. But as we've seen in the past, there may be scope for compromises on both sides, and I think it will take that. And if they were to get that, then I think if they come out on Thursday and say, okay, we've agreed a trade deal, you're going to see the pound shoot up. But if they come out and say there's no deal, you're going to see the pound getting absolutely trashed.
And this is guaranteed on Thursday, this statement?
Well, there should be. Well, you see, but they may, the EU typically will either come out with a statement on Thursday or Friday, because the meeting itself actually ends on Friday. The problem here is that Boris Johnson has said that October the 15th, which is the Thursday, is his deadline. And if there's no agreement by then, it doesn't matter. He's going to walk away. So I think as far as the market's concerned, the focus is currently upon what is either side going to say on Thursday. So watch this space, as they say, because it could have ramifications for a number of markets. Because say if it would be if they come out and say, right, there's no deal, discussions are now off, and there's going to be UK is going to end its transition period at the end of this year and move straight onto World Trade Organization tariff deals. Then that's certainly going to be bad news for the UK economy. But it's also going to be bad news for the Eurozone or European economy as well. So if it's bad for the pound and it's bad for the euro, presumably it's got to be good news for the dollar and also for the likes of a Swiss franc. So this could have knock-on effects, across a whole range of currencies. What else have I got from my side? I suppose I should mention latest goings on the interest rate front. I still think from what the ECB are saying, your side, of course, the Fed's saying no to negative interest rates, if I remember correctly, from what you said before. Yeah, on this side, ECB still seem to think, of course, they've got negative interest rates, but there still seems to be no appetite to take rates down any further. But the Bank of England yesterday sent out a letter to the CEOs of a number of firms explaining that the central bank is starting a consultation period on negative and or zero interest rates with the financial sector. Now, they're went on to say that, this is just at this stage a discussion with firms. It's asking them really, they don't have to take operational steps to be ready for a negative interest rate regime yet, but basically how long would it take them to do it, how easy it would be for them to do it, and so on and so forth. So I think the bottom line to all this is that will the bank come out and cut interest rates at its next meeting on, where are we, November the 5th? No, that's very unlikely. Could they though cut interest rates if the COVID numbers continue to escalate over here as they are at the moment? Yes, they could do, perhaps at December, or perhaps at some point next year. So it does mean that although there's been this toing and froing from the bank over whether or not negative interest rates are a good thing, they are at least still a possibility, even if not necessarily a probability. Okay, what else we got? Well, I suppose from my side on the numbers front, it's really quite quiet this time round. This week it's going to be the Thursday EU meeting that has the the biggest impact on markets. Are there any big figures to look forward to on your side?
Yes, we do. We do on Friday. It's it looks to be upstaged by the European. If we don't already have those headlines by, especially if we don't have those headlines by Friday. But Friday morning here, we're going to have retail sales and industrial production for September. That's both the key numbers on the supply side and key numbers on the demand side. Moderate to solid is the expectation, Conaday's consensus for retail sales ranging from 0.7% overall, which looks like a really good, strong monthly gain. But the key core reading, the control group, which removes volatile elements, is only 0.2, and that was in the negative territory in August. So that could take, so you want to double check before you make any conclusions on retail sales, that you look into the details of the report. Industrial production looks to be a little bit more solid, 0.6% overall, with manufacturing output, the expectation 0.8, which would be very good, but this is still struggling to get up to where it was in February. So it looks to be a moderately positive news. I'm not sure it would have to take a very out of the range result to, I think, make a big significant change, plus negative or positive on the outlook, which is I think policymakers are still, cautiously optimistic. Listening to Jerome Powell last week, it's still, a solid recovery. But today's CPI wasn't so hot, and there's other indications that the third quarter and the fourth quarter rebounds may not be as spectacular as advertised or as thought, and that would. In any case, the outlook for 21 is still a completely really unknown. It's going to be tied to COVID over here, where the rates are so much higher. Infection rates are so much higher than they are in other parts of the world. But it's not leading yet to significant new restrictions or even talk about such restrictions, even though hospitalizations are up and those kinds of things. It hasn't become a big issue yet.
Yeah, that could be important, because that is what's happening very much right across Europe now. I mean, a number of most of the, well, I say most, I think all countries now right across Europe are seeing rising COVID numbers, and some countries, UK now included, are seeing a rapid escalation. So we will have new restrictions here being introduced as of tomorrow, a new so-called 3-tier system. I think France has already announced we've pretty well got disaster states in about 9 major cities. Germany also is starting to screw the lid down again. So I think you're talking about fourth quarter. Well, I think definitely forecasters will be revising down their expectations on Eurozone, or indeed European growth for the fourth quarter, because of what's going to happen over the next several months with regards to restrictions. So if your side can get away without them, then that could be quite positive news as far as the dollar's concerned. Okie dokie. Anything else? Let me just ask you one last question. Before we go. I don't want to spend too long on politics, since we're supposed to be vaguely economics. But just it does seem to me, as obviously a clear outsider from many miles away across the water,
Lucky you.
Oh yeah, well, you should try our side. But Joe Biden would appear to be maintaining, if not increasing, his lead in the polls. And that would appear to be having, from what I can see, very little impact upon anything. So is it now the case that investors just take the view, if Mr. Trump wins, then we're going to see some kind of fiscal package. If Mr. Biden wins, we're going to see some kind of fiscal package. So why worry about it? And does this mean we're in a win-win situation here?
I guess you could look at it that way, but just the reference to the polls is, they have proven themselves like the understanding of inflation, and think of all the wasted effort that all those economists over 2 generations spent on the natural rate of unemployment and those issues and the Phillips curves and those kinds of things. I mean, it was just a waste of time, and so I mean. Perhaps this polling is that science is also proving itself deficient, but and I guess a massive stimulus, unless there perhaps is a conflicted result where neither side has a mandate, then that might limit stimulus. But it's hard to say. Unlimited fiscal stimulus, is that in store where we can expect stimulus checks at routine levels to keep rents paid? Is that the outlook? That's not for the American ideal, or the what's the word I want? It's not really the ideal, but it's the word escapes me right now. But it's not. Is Europe, Europe, I think, has a tendency, and correct me if I'm wrong, that continental Europe at least has that the government subsistence is a natural right for a citizen.
Yeah.
That is not so clear traditionally over here. And I'm not sure that that's playing out much, but I think it could be in the background, and that's what we're moving toward. With this, need to do whatever we can to maintain our economies. So I think that is an interesting background abstraction that is like I say, playing out over here.
Interesting. Very well put. Okay, then let's wrap it up there before we prattle on too long as usual. So we'll call it for this week. On behalf of Mark and myself, thanks as ever for listening. We'll be back next week. But of course, in the meantime, you can keep up to date with all the key market moving data and events in Econoday's global economic calendar. Stay safe, and we'll see you next time. Bye for now.